them it's Paulson wireless mic. Okay, folks, let's get started. Couple of things. First, I've been sending you those reminders about the mystery project. I think I've sent you 3 times, and I'll keep reminding you all week. But how many of you have looked at the data? Okay. Those who haven't looked at the data, that's the first step in the project, is actually looking at the data. It's a huge Excel spreadsheet. It's got 313 companies with about 100 columns of data. Okay? I picked up pretty much every data item that I conceivably could think of you using, and I put it all into a spreadsheet. The raw data is not difficult to get. I pulled it off S&P Capital IQ. What I did was I classified it so that you're not digging through what item goes where. So anybody read the mission statement? What do I want you to do? Greg, what's the project about? Do you remember? It's a pricing mission. Basically, I want you to do something very simple for me. There are 313 companies with all this data. I want you to tell me which 5 are your cheapest companies and which 5 are your most expensive companies. Now, here's what I don't want you to do. Start with A and work through Z and do an intrinsic valuation of each one, because that is not the project. The project is a pricing project. I want you to tell me which 5 companies are cheapest or most expensive on a pricing basis. I'm not trying to be mysterious, but basically when I say do a pricing judgment, what am I asking you to do? Relative to those other 312 companies, is this company cheap or expensive? So you know what you need to do next, right? You got to open up columns and compute the multiples that you want to use to compare them, because you can't compare prices across companies. Then you got to think about what you want to control for. And today's class is actually going to be exactly what you will be doing in much smaller experiments. Because when you think about controlling, I'm going to give you some tools or techniques you can use. It's all common sense. But essentially you're saying, this company looks cheap, but does it deserve to be cheap, or is it really cheap? Now, as you look at these companies, though, the one thing I want to tell you is I picked the 313 largest publicly traded companies in the world, which are non-financial service companies. It's not because I don't think financial service companies belong, but financial service companies actually narrow the multiples you can use. You're restricted to using only equity multiples, so I wanted to be able to pick across multiples. So already you can tell this is a subset of the universe. It's a subset that's fairly heavily followed. So if something looks insanely cheap, you probably haven't looked hard enough, right? It's unusual for a company, but still you might find a bargain, and that is in fact what you're going to be trying to do. The second part of the project, and the first part is coming up the 5 cheapest, 5 most expensive, using whatever multiple and techniques you want to use. The second part is to put yourself in the shoes of a private equity investor who plans to take over this company, change the way it's run, and then take it back to the market. Now, I want you to think about what you would look for if you were that kind of private equity investor. And what you might look for in that second scenario could be very different than what you look for in the first one. The first one, you're a passive investor. You buy cheap stocks and you hope that something good happens. You sell short and expensive stocks, you hope that something good happens. In the second one, you get to change the company. So what you might look for would be very different into the second question than the first one. So try it. It might seem like just grunt work, Excel, but this is at the heart of investing, because the challenge you face is there are 41,900 companies competing for your money, if you have any left. Okay? And you have to decide where to put your money. This is kind of a compressed version of it. If you can do it with these companies, you can do it with the entire market. So let's start with today's start of the class questions. And in a sense, it's going to frame what you're going to be doing in a mystery project as well. So I come to you with 3 companies. A, B, and C. I was being incredibly creative in naming the companies. They all have the same cost of equity, 10%. So let's say they're in the same business. Company A has a return equity of 12%, company B has a return equity of 10%, company C has a return equity of 8%. If I were looking at price to book value, market cap of equity versus book value of equity, which of these 3 companies is most likely to be trading at below book value? This is an easy one. Which one's going to be the most easy? See, and what about it makes it, it's earning a return on equity less than its cost of equity. Basically, that it doesn't mean that the other companies are bad companies. In fact, if I asked you to classify these companies based on quality of management, you know which company would be ranked first? As an investor, company C would be the company that ends up being the cheap company. But as a management consultant looking at the quality of management, you'd say company A is in fact the best run company. And I want to emphasize that point because all too often we mix the two together. And I blame value investing, old-time value investing for this, where they'd say quality companies make quality investments. Why? At the right price, a horribly run company can be a good investment. At the wrong price, the best run company in the world is a bad investment. And we're going to have to start to divide our views about how we think about a company in terms of its quality of management and how we think of it as an investment. So company C has made some bad investments, right? Its return equity is 8%. The accountants wake up and say, you made a lot of bad investments, and they decide to write off those bad investments. One-time charge. Wipes out 50% of the book value of equity. The second after they do that, what's going to happen to the price-to-book ratio? It used to be less than 1 before, right? The write-off itself is no surprise. Everybody knows why they're writing it off. By the time accountants get around to writing things off, it's common knowledge. The price says, it took you a while. 6 months ago, the bad stuff happened. The price stays what it is. The book value drops. All of a sudden, this company is going to go from a low price-to-book ratio to a high price-to-book ratio. But think about its return equity. What's going to happen to its return equity? It's also going to double. And that's why whenever you talk about price to book, you want to companion it always with the return equity, because if you just look at one half of the equation, you're going to get the wrong impression, right? So if you look at just the return equity after the write-off, you're going to conclude this is a really well-run company. Look, its return equity is 16%. Always bring the price to book and the return equity together. Today I'm going to talk about companion variables. Every multiple has a variable that it's latched onto. And you need to control for that when you talk about that multiple. So in that same vein, let's think about revenue multiples. Widely used to tech companies, sometimes used with retail companies. Let's assume you're looking at revenue multiples across retail companies. So you're looking at the market value of equity divided by revenues or enterprise value divided by revenues. I'm not going to give away the game, but let's suppose you did this across all retail companies. I want you to tell me, if you just looked at the EV to sales ratio, what kinds of companies are going to look cheap to you because they have low multiples of revenues. And I'll go down the list, and as you go down the list, think about what it is that causes differences in revenue multiples across companies. So here are the choices: department stores, discount retailers, or luxury retailers. Who's going to look cheap just based on EV to sales? Really? Department stores are going to look cheap. Why?
Discount retailers are Amazon. So department stores, because the sales capital ratio is very capital intensive. It's going to have a low sales.
How are they capital intensive?
You have to have all this real estate, you have to maintain all this inventory.
Discount stores could be Walmart and Costco. Why do you jump to Amazon automatically? I don't think of Amazon actually as a discount retailer. They sell everything, including luxury goods, right? So what does that mean when you sell stuff at a discount? What does it mean? In terms of where would you see that in your income statement? You have low margins. Okay, what's the next step? When you have low margins, what kind of multiple of revenues are you going to trade at? Lower multiples. Discount stores are actually going to look cheap. Walmart actually has what? Revenues of $350 billion. Its market cap is $250 billion. It trades at below revenue. It doesn't make it a cheap company because of its business choice of selling stuff at low margins. So when you sell stuff at low margins, you are going to trade at a low multiple of revenues. It doesn't make you a bad company if you have really high revenues. And that's in fact the Amazon game, right? They're not making high margins, but they're hoping for high enough revenues that you're willing to pay a multiple. Even if you pay 1 times revenue, if your revenue is $250 billion or $350 billion or $450 billion, your market cap will go up. Luxury retailers are going to trade at really high multiples of revenues, but before you think that's a good thing, if you have only $1 in revenue, what does it matter that you trade at 30 times revenues? You're still worth only $30. So if you just look at multiples of revenues, the low margin businesses will tend to look cheap because they will trade at low multiples of revenues. In fact, to show you how much margins can vary, this was from a couple of years ago. Smartphone business was exploding. You had Apple versus Samsung versus everybody else. So I found this table in the Wall Street Journal, and I found it fascinating because if you look at the margins for the different players in this business, there's Apple at the top, right? Their margin is 28, 29, 30. So it's basically in the 28 to 35% ranks. You go to Nokia, 15% dropping to 4%. Samsung, not bad, 8 to 17%. But as you compare across, you can see already that Apple's margins are almost twice as high or 3 times as high as everybody else in the business. You know where this is going to show up, right? So when I look at the revenues of Apple and the enterprise value for Apple, I would expect Apple to trade at a much higher multiple of revenues because they have much better margins. In fact, I'm going to use this in next class to actually value a brand name. You see the opening I'm going to use? What's the value of a brand name? You get to charge a higher price for exactly the same product. The minute I make that statement, I'm giving you a way of valuing brand name because it's going to show up in your margin and your revenue multiple, and I should be able to back out of it what the value of your brand name is. So hold on to that, because today's class, you're going to play the role of recipients of bad advice, and I want you to tell me what part of my advice is missing the facts. Okay? So let's go back to, I think, page 34. Shoot. Okay. So remember last session I ended by showing you a chart of PE ratios across time and CAPE and normalized PE. So I'm going to play the role of a market strategist. So that's going to be my job today. I'm going to give you really bad advice, and I want you to tell me why my advice is bad. So here's my first ploy at giving you advice. I tell you that stocks are expensive today because they trade at really high PE ratios. And let's face it, this is actually an argument you read almost every day nowadays. Stocks are expensive because they trade. It could be true. But I want you to play devil's advocate with me, remembering what drives the PE ratio, right? What are the 3 variables that drive the PE ratio? Cost of equity, growth, and payout/return equity, the quality of your growth, right? So it is possible that stocks are expensive today because the PE ratio is high, But what else could explain the high PE ratio? Let's go down the list. Is there something in the cost of equity that might systematically have changed that explains a high PE? What are the two ingredients in the cost of equity? Risk-free rate and an equity risk premium, right? So you look across 1953 to today, the risk-free rate today is much lower than it was. Already you have pause in your argument saying maybe that could explain it, low interest rates. Let's move next to the list, growth. That's a tougher one because growth in earnings seems to have leveled off. So based just on growth, you'd expect PE ratios to be lower rather than higher. It's not like it's 2009, you're coming into that growing from depressed earnings. And there is a return on equity argument you can make, though it gets a little messy. Returns on equity at US companies have been climbing over the last 20 years. That's the good news. You know what the bad news is? Why are they climbing? Well, that is part of it, but there's an even bigger factor, an even more immediate factor. Think back to what I said about dividends and what dividends have been replaced with. You know what happens? The minute you buy back stock, what happens to your book equity? It shrinks. So returns on equity are going up, but not because they're taking better projects, but because their book equity is shrinking. So it's kind of a mixed message, right? So already you can tell that if I told you that PE ratios are high, therefore stocks are expensive, you should say, wait, that might or might not be true. What about the fact that risk-free rates are lower? But this is an argument we've heard over and over again for the last 4 years. It's in fact the basis for some market gurus saying, the fall is coming, it's going to burst tomorrow, the bubble's going to burst, the market's going to come down, prices are high. So this argument doesn't seem to make sense. What if I have a Nobel Prize and I make this argument? It's still a bad argument, right? And that's, in fact, the basis for why I think those who use the Shiller PE to say stocks are overvalued are essentially being lazy. So here's what I did. I took the PE ratio for US stocks and I inverted it. It's called the earnings yield, earnings to price ratio. So if you look at this graph, you see this orangey line, that's the earnings to price ratio over time. I've also graphed out the T-bond rate over time, the blue line. Just take a look at those two lines and tell me whether it looks like they move together. I don't even have to do any correlation or regression to tell you that the two move together. For much of history, when T-bond rates are high, earnings to price ratios are high, which means PE ratios are low. When T-bond rates come down, earnings to price ratios come down, PE ratios come up. The third line there is the difference between the T-bond rate and the T-bill rate. What am I measuring when I look at the difference between the 10-year T-bond and the 3-month T-bill? I'm measuring the slope of the yield curve, right? When you see a 0 there, I have a flat yield curve. When you see a negative number there, which has happened historically a few times, you have a downward sloping yield curve. When you see a big positive number, you've got an upward sloping. You say, who cares? It seems to affect PE ratios. Historically, whether the term structure is flat, upward sloping, or downward sloping seems to have an impact. We think about why that might be. But I have 3 different series over time. I could look at this graph till my eyes fall out. But if your question to me is, are stocks cheap or expensive today? There's no way looking at this graph is going to let me answer that question, right? Because depending on my prior biases, on the one hand, on the other hand, and I don't want to go there. So this is something that I suggested early on in the process. When you're doing pricing, the tool that you need the most is statistics. Right? Because statistics was designed for this. In fact, here's what I did. I took the earnings to price ratio going all the way back to 1960, and I ran a regression against the T-bond rate and the T-bond rate minus the T-bill rate. If you look at the coefficients, you already see the slope of the term structure has become much less. It's statistically insignificant. But the T-bond rate is statistically significant. You're saying, what does that mean? 0.5598. Every 1% increase in the T-bond rate increases the earnings to price ratio by 0.56%, which means your price earnings ratio is going to be lower. Just in the last week, the T-bond rate has increased by 0.6%. Not because the Federal Open Market Committee is meeting, and that I think should cast as a lie. All these last 8 years we've been saying, hey, the Federal Open Market Committee is going to make rates go up, and guess what? They're not even meeting and the rates are going up anyway. Okay. But if you forecast out that T-bond rates a year from now are going to be at 3.5%, so what will that do to earnings to price ratios? The answer from history is earnings to price ratios are going to go up by about 0.7 or 0.8%, which translates into a drop in the PE ratio of about 3 to 4. So the PE ratio will go from 18 to 15 or 15.5 if you believe history. But here's the catch. If you look at this regression through 2008, the R squared was almost 10% higher. The slope on the T-bond rate versus the T-bill rate was almost statistically significant, and the T statistic on T-bond rates were much stronger. Over the last decade, that linkage between price-earnings ratios and interest rates is starting to fray. We talked about structural shifts, and I talked about how 2008 changes the way we think about markets. This regression is another regression I've been tracking, and if you look at post-2008, pre-2008, you see very different relationships. Now, what was the thing that I started with? I said, if I wanted to see if stocks today are expensive or cheap, can I use the data? How would you answer? If I came to you and said, tell me, are stocks cheap or expensive today based on PE ratios? How would you use this regression to answer that question? What would you do? Take the 1960 to 2014 regression. What would you do to answer the question whether PE ratios today are high or low? You could plug in today's T-bond rate into that regression and today's T-bill rate into that regression. If you plug in today's T-bond rate into today's T-bill rate, you get an earnings to price ratio of about 4.85%. You're saying, what does that mean? An earnings to price ratio of 4.85% inverted becomes a PE ratio of about 21. The actual PE is 21, and your predicted PE is 21. Even though it might be higher than historical PEs, stocks are fairly valued after you've controlled for the level of interest rates today and the T-bill rate today. So if you get a chance, plug in today's T-bond rate, 2.25% checked as I came in, and today's T-bill rate, which is about 0.45%, and see what you get as today's predicted earnings to price ratio, and then compare it to the actual earnings to price ratio, which you should be able to find online. And see, make the judgment for yourself whether stocks are cheap or expensive. Any questions about market PEs? Now let's move on to PEG ratios. PEG ratios terrify me. They terrify me because people who use them seem to have this misconception that when they use them, they don't have to control for growth anymore. So let me first back up and explain what a PEG ratio is. Here's what you do. You take the PE ratio, price divided by earnings, and you divide the price-earnings ratio by the growth rate. So let me give you an example. Let's suppose you have a stock with a PE ratio of 20 and an expected growth for the next 5 years of 10%. 20 divided by 10 is 2, so your PEG ratio is 2. You're saying, how would I use this? Let's suppose I have a second stock with a PE ratio of 10 and a growth rate of 8%. 10 divided by 8% gives me 1.25. Here's what I'm going to say. The second stock is cheaper relative to the first stock because it trades at a lower PEG ratio. So the presumption here is PEG ratio is controlled for growth, so therefore I should be able to control, just compare companies with different growth rates and be able to use the PEG ratio. So you look at tech equity research reports, you see PEG ratios used all the time. But let's start off with that question. Do PEG ratios make growth go away? And the easiest way I have of trying to answer this question is to go back to that two-stage dividend discount model I showed you when I looked at PE ratios and do the algebra. And when I do the algebra, here's what I end up with as the PEG ratio. This is an intrinsic PEG ratio for a company. And guess what? The PEG ratio for a company is a function of 3 variables. Its growth rate, its payout ratio, and its cost of equity. If you remember, the PE ratio is a function of exactly the same 3 variables. When I create a PEG ratio, growth doesn't go away from the equation. In fact, it gets everywhere. It gets really messy because it's in the numerator, it's in the denominator. At least with PE ratios, I could tell you if growth goes up, PE goes up. With PEG ratios, you can see the effect is going to be much more complicated. Now, I know that's a really abstract equation to work with, so let me use that hypothetical example I used before to bring this home. Because what I want to emphasize is when you divide PE by growth, growth doesn't go away. It stays in the equation. It just gets much more difficult to predict the direction of the relationship. Okay? So let me give you that example that I used with the PE ratio. A high growth company, 25% expected growth for the next 5 years, 8% thereafter. Payout ratio of 20% for the next 5 years, 50% thereafter. Beta is 1 in both time periods. I computed the cost of equity, 11.5%. I plugged the numbers into the PEG ratio equation. I came up with a PEG ratio of 1.15. What does that mean? If this stock were trading at exactly its fair value, the PEG ratio should be 1.15. Now here's what I did next. I said, let's see what happens to the PEG ratio if I increase the riskiness of the stock. Holding all else constant, if I change the beta, here's what happens to the PEG ratio. As my beta goes up, my PEG ratio goes down. Why? Think about it. If you have a risky company, the same growth will deliver a low PE ratio. Last week I was looking at equity research report on a tech company put out by a sell-side analyst. And here's what he did. He came up with a PEG ratio for his company. And he compared it to the PEG ratio for the S&P 500. This was a young, risky tech company. He computed the PEG ratio for his company, PEG ratio for the S&P 500. He compared the two numbers and he said, the company is cheap because it's trading at a lower PEG ratio than the market. You can see the opening is left for you, right? Because what's the obvious explanation for why the stock looks cheap? It's a young tech company. It's a risky company. It should have a lower PEG ratio than every other company in the market. So you need to control for risk. I also looked at the payout ratio, which in a way, indirect way, is what's the return equity of the company. Holding all else constant, the higher my return equity or payout ratio, the higher my PEG ratio will be. So for a given growth rate, higher return on equity companies will have higher PEG ratios. Remember at the end of the process with PE ratios, I asked you, what's your cheap company look like? I wanted to start thinking about what a cheap company will look like on a PEG ratio basis. It'll have a low PEG ratio, low risk or high risk. You don't want anything that explains away the low PEG ratio, right? So you don't want it to be high risk. You want it to be low risk, low return equity or high return equity. You want a high return equity. You want a low PEG ratio, low risk, high return equity. Then I took a look at growth, and this is what terrifies me about the PEG ratio. As I increase my growth, initially the PEG ratio decreases. You're saying this is good, so therefore higher growth companies will have lower PEG ratios. Well, not so fast. There is a certain point at which the PEG ratio starts to seem to want to go back up again. It's almost a U-shaped relationship. And now do you see why using PEG ratios becomes diabolically difficult? When I ask you what's a cheap stock based on a PEG ratio, you're going to say low PEG ratio, low risk, high return equity. But what growth do you want? You want a really low growth or a really high growth? That doesn't really help me, right? It's two extremes that you end up with the high PEG ratios. It's a very difficult multiple to use because the relationship with growth becomes incredibly messy. So let me summarize basically what I see about PEG ratios. High-risk companies will look cheap to you on a PEG ratio basis. So if you do PEG ratios for your 313 companies, don't be surprised to see the companies that are in emerging markets look cheap to you on a PEG ratio basis. Don't be surprised to see the companies with high standard deviations or high betas look cheap to you on a PEG ratio basis. Companies that have higher returns on equity generate growth more efficiently, trade at higher PEG ratios. So when you look at really low PEG ratio companies, check out the return equity. Maybe the return equity is 2%, 3%, 4%. And finally, companies that fall right in the middle of the growth spectrum of your sector will look cheap to you on a PEG ratio basis because you have that U-shaped distribution. The really low and really high growth companies will have high PEG ratios. So in a sense, you want to make sure that when you use PEG ratios, you are controlling for differences, but controlling for growth differences just gets a lot more messy. So PE ratios, PEG ratios. Let's talk about price to book. By the time I hit the fifth multiple, you're going to say, this guy seems to be doing the same thing over and over again. And I want that to happen because I want it to become second nature for you. That when you look at a multiple, you go back and do the algebra. So price to book ratio is an equity multiple, right? An equity multiple, to disentangle the multiple, I go back to a dividend discount model. I divide both sides with the book value, and after I do the algebra, here's what I end up with. The price to book ratio for a stable dividend paying stock is a function of 4 variables. The first 3 are payout ratio, cost of equity, and growth. Sound familiar? Those 3 show up almost every time you look at an equity multiple. The 4th variable that pops up is the return equity. Remember I talked about companion variables? The companion variable for price to book is return equity. And here's what I mean by that. High return equity companies will trade at high price to book ratios. Low return equity companies will trade at low price to book ratios. In fact, I can even simplify this equation a little bit more if I use that growth equation we had when we talked about sustainable growth, retention ratio times return equity. If I plug it back in, the price to book ratio can be written as return on equity minus the growth in the numerator, cost of equity minus the growth in the denominator. In fact, if you look at that equation, you can already see that if you have a stock that has a return on equity roughly equal to its cost of equity, it should trade at roughly book value. Price to book should be 1. If its return equity is less than the cost of equity, it should trade at less than book value. If its return equity is much higher than its cost of equity, it could trade at 2 times, 3 times, 4 times book value without being expensive. Now, if you change this equation and make it an enterprise value to invested capital, which is kind of the firm analog to price to book, enterprise value to invested capital take a look at price to book. Price to book is return equity minus cost of equity, minus growth, cost of equity minus growth, right? When I do enterprise value to invested capital, I replace return equity with return on invested capital. I replace cost of equity with cost of capital. Same relationship applies at the enterprise value level. Companies that earn their cost of capital, and take a look at your DCF, see if this works out. Take a look at what you got as the intrinsic value for your company. Take a look at the return on capital of your company. If it was less than the cost of capital, you could have ended up with a value for your company well below its invested capital. Not because you did the valuation wrong, but because you've left the return on capital below the cost of capital. So the companion variable when you're looking at enterprise value to invested capital becomes return on capital. Final enterprise value multiple. Enterprise value to EBITDA. We talked a little bit about the netting out of cash and why we do it, but it's the fastest growing multiple in use. It's used in more equity research reports now than probably any other multiple. Perhaps price earnings ratio is more widely used, but this is catching up. So let's think about what the variables are that you want to control for. Let me reframe what I mean by these variables you want to control for. Think about getting a sales pitch from somebody who's trying to sell you a company. Right? I call it and say, I have a cheap company for you. When I talk about the variables you want to control for, I'm thinking about the questions you need to ask me when I tell you a stock is cheap. So when I say stock has a low PE ratio, the first question you're going to ask me is what's its expected growth. Second question you're going to ask me, how risky is it? Third question you're going to ask me is what's its return equity. And by the time you ask those 3 questions, 95% of my sales pitches are dead in the water, right? I want to give you the same question to ask when I try to sell you something on an EV to EBITDA basis. So I come to you and say, this company is cheap, it trades at less than 4 times EBITDA. What are the questions you need to ask? And here again, I went back and did exactly what I've been doing with every other multiple. I went back to a DCF model. This case, I went back to a firm valuation model because I'm looking at an enterprise value multiple. I did the algebra, and the algebra is messy. The enterprise value to EBITDA multiple for a company, if I write out the free cash flow as EBITDA times, so this is basically just writing the free cash flow in more expanded format. Here are the drivers of enterprise value to EBITDA. The first variable is the tax rate. The higher your tax rate, the lower the multiple of EBITDA you will trade at. How come when we did PE ratios and price to book, we didn't care about tax rates? Why didn't we care whether you have a high tax rate or a low tax rate? Because I'm looking at net income, which is already after tax. So if you're looking at a high tax rate, it's already in your income. But because I'm climbing the income statement, you got to put a check on me. So what's your tax rate? The first variable is your tax rate. The next 3, depreciation, capex, and change in working capital, if you consolidate them, is your reinvestment rate. For any given growth rate, the second question you're going to ask me is, how much are you reinvesting to get this growth? And if I'm reinvesting huge amounts to get very low growth, guess what? I should be trading at a low multiple of EBITDA. The third variable you should be asking me is what's your cost of capital, which will be a function of what business I'm in and what country I'm in. And if I'm a very risky company in a very risky country with a high cost of capital, I will trade at a low EV to EBITDA multiple. This might sound like a very negative way of approaching things, but guess what? That's your job, is to be really negative and cynical about this process, because you know the guy on the other side has an agenda. He's trying to, or she's trying to sell you something, and your job is to make sure you're not being sold a bag of goods. Is that right? Whatever. Okay? So let's think about how this works out with actual numbers. So let's say you have a company with a 36% tax rate. CapEx is 30% of EBITDA, depreciation is 20% of EBITDA. Cost of capital is 10%. For simplicity, let's assume no working capital requirements. I come to you and ask you, what is a fair multiple of EBITDA for this company? An intrinsic EV to EBITDA. I plug the numbers into the equation from the previous page. 36% tax rate, 10% cost of capital, 5% growth rate. I put in the depreciation CapEx, no working capital. I come up with about 8.24 times EBITDA as an intrinsic EV to EBITDA multiple. Again, as with the previous examples, it's not what you get as an answer to this particular problem that is useful. It's when you change the variables, you can see how that multiple changes. So here's the first variable I changed. I changed the tax rate for this company. Remember I used a 36% tax rate? I dropped it to 0%. You're a company in a no-tax environment. Same characteristic, you should trade at 16 times EBITDA. If you have a 50% tax rate, you should trade at 6 times EBITDA. You see, this is absurd. Why would I ever get differences like this in the tax rate? Let's say you're the telecom analyst for Europe. And in your sector, you have Irish Telecom and you have Deutsche Telekom. Irish Telecom faces a 12.5% tax rate. Deutsche Telekom faces a 30% tax rate. If you're not careful, if you just pick stocks based on low EV to EBITDA multiple, what are you going to be loading up on? Which of those two companies? You're going to end up with Deutsche Telekom because with a higher tax rate, it's going to be trading at a lower multiple of EBITDA. You say, this looks cheap to me. When in fact, all you're capturing are differences in tax rates. So if you get a chance, take a sector that's global, print out the EV to EBITDA multiple, see if you can get at least a relationship between EV to EBITDA and tax rates, because it is one of the variables you have to control for. I kept everything else constant and changed my reinvestment rate. And here's what I found. The more I have to reinvest to get that 5% growth, the lower my EV to EBITDA multiple is going to be. Do you see why? Because to get that 5% growth, if I have to put back huge amounts of CapEx, the EBITDA looks great. But remember, that's before taxes and before CapEx. So by the time I'm done with my taxes and my CapEx, there's nothing left. So the higher the reinvestment for a given growth rate, the lower the EV to EBITDA. But here's another way of saying exactly the same thing. If I keep growth fixed and I increase my reinvestment rate, what am I doing to my return on capital? The return on capital is going down. So if I hold everything else constant and I increase my return on capital for the company, my EV to EBITDA is much higher. If I lower the return on capital, my EV to EBITDA is much lower. So you ready? I'm going to be the salesperson. I'm going to try to sell you a company that's trading at 4 times EBITDA. So ask me the first question. Come on, it's right there in the graph and behind you. What's the tax rate, right? So, you know, I might have a 75% tax rate, in which case you're going to hang up the phone. So don't worry, it's only a 20% tax rate. Ask me the next question. What kind of return on capital did you make last year? If it's minus 7%, you hang up the phone. If it's 17%, well, you're interested. You have a low tax. So you're looking for that combination that makes a company cheap. And with EV to EBITDA, here's what you need. You need a low EV to EBITDA. That's a given. Low tax rate or high tax rate? You want a low tax rate, you want a high return on capital, and a low reinvestment rate. And if you can pull that off, and if you can add on cost of capital, go ahead and throw it in. You want a low cost of capital. That way you've got all the stars aligned. It doesn't guarantee you're going to make money, but at least you checked to make sure that this is a company that is not just looking cheap, but is cheap. Any questions on EV to EBITDA? Final big multiple, revenue multiples. Again, I'm going to do the algebra. I'm going to save you the trouble of dragging you through the details. But if you do the algebra, here's what you're going to end up with as the variables that drive revenue multiples, or EV to sales. The EV to sales multiple is a function of 4 variables. The first is the reinvestment rate. The second is the cost of capital. The third is the growth rate. That's the analog to return equity, payout ratio, and cost of equity. And then you see a variable pop up, and this is your companion variable. It's the operating margin. Companies that have high operating margins will trade at high EV to sales ratios. Companies that have low operating margins will trade at low EV to sales ratios. So price to book return is the companion variable is return equity, Enterprise value to invested capital, it's return on capital. With EV to sales, it's operating margin. So when I try to sell you a company and say it's cheap, it's trading at 20% of revenues, first question you need to ask me is, what kind of operating margin does it have? And if it's a grocery store which has 1% margins, don't be surprised to see it trade at 25% or 30% of revenues. That's exactly what you should expect to see. So I'm going to use this as my platform to value brand name. And I'll tell you what got me started on this was listening to marketing people constantly use brand name as a buzzword. You have this brand name company, you do a discounted cash flow valuation, and say, well, you missed something very critical. You missed the fact that it's a valuable brand name. So I'm going to strip things down to basics, and if you're a marketing person, you're welcome to tell me what I'm missing. To me, the essence of a brand name, the power of a brand name is you get to charge a higher price for exactly the same product. And I'll give you the example that I've probably given in some other context. If you want to see brand name at play, walk into the Dwayne Reed that's at the end of the street. Walk down the painkiller aisle and check out the aspirin offerings. You're going to see the Dwayne Reed, the generic aspirin, and right next to it you'll see Bayer aspirin. Check out the prices. And if you're suspicious, check out the ingredients. I guarantee you, the ingredients are exactly the same. But here's the final check. Think about how many times you bought the Bayer aspirin and how many times you bought the Sudafed rather than the generic version, because you are convinced in your head that when you take the Sudafed, your allergies seem to go away faster. That is the power of a brand name. Exactly the same product, right there in front of you, and you're willing to pay a higher price. It's not being irrational. Brand name, by its very nature, has nothing to do with rationality. They played enough, Coca-Cola has played enough games with your mind for the last 100 years. Say, if you don't drink Coke, you'll never be happy again. If you don't wear Gap khakis, you will never dance again. Those things get embedded in your mind. And that is really the power of a brand name. So here's how it shows up. If you get to charge a higher price for exactly the same product, you're going to have higher margins, right? If you have higher margins, you're going to trade at a much higher multiple of sales. So to value brand name, here's what I'm going to do. I'm going to ask a question. It's a very unrealistic question. What would happen if tomorrow you woke up and your brand name had completely dissipated? Nobody recognized the word Bayer or Coca-Cola or Sudafed. What's going to happen? Well, nobody's going to reach for your product and pay the higher margins, right? Your margins will have to come down because you're now a generic manufacturer. If your margins come down, your value to sales ratio will come down. And if I can compare what it was with their higher margins and what it will be with your newer margins, that difference should be the value of a brand name. This works best when you have a product like aspirin, like soda, like cereal, where there's really no difference between the products. It's really brand name power. It's much more difficult to apply this in other contexts. We'll talk about it. But let me take a company where I think we can all kind of agree that brand name is the power that drives this company. It's Coca-Cola. So about 10 years ago, I was asked to come in and value Coca-Cola for their top management team. So there were like 15 people in the room. And they asked me to do a discount. They wanted to understand what drives the value of Coca-Cola. So I go through my cash flows, I come up with the discount rate, I come up with the value of about $79.6 billion for the company. Traditional, free cash flow of the firm, discounted the cost of capital stuff. So I finished the valuation. Guy in the front row, the head marketing honcho at Coca-Cola, puts up his hand. Says, you forgot something very important. So what did I forget? An entire division of business? So what did I forget? He said, you've forgotten the fact that Coca-Cola is the most valuable brand name in the world. I said, what exactly do you want me to do? He said, you should be adding at least a 20% premium to your $79.6 billion. He said, why 20%? He said, because that's what we do at Coca-Cola, is when we buy brand name companies in other countries, we do a valuation of that company, and then we add 20%. My reaction was, just because you do stupid things doesn't mean I have to do stupid things too. He says, don't you think brand name has value? I said, it is immense value. He said, how come you're not adding a premium? What's the answer to that? Because it's already in there. I don't know, you guys are probably too young to have ever seen this commercial, but this was about 30 years ago. It was a commercial for Ragu spaghetti sauce. This is a TV commercial. So the commercial starts off with this 45-year-old Italian guy, big-time loser, obviously, coming into his mother's house to have dinner because he seems to come back to his mother for dinner every night. And he walks into the kitchen, and she's standing in the kitchen cooking, and she's surrounded by empty bottles of ragu spaghetti sauce. And he says, "Mom, you're making spaghetti sauce from a bottle? You always used to make it from scratch." To which her response is, "If you didn't show up every night, I'd make it from scratch." And then he says, but then he starts listing up the ingredients. "I'm not that good with spaghetti sauce. If any of these don't belong in there, just take them out." He says, "Where's the tomato?" Let's start obvious. It's in there. "Where's the oregano?" It's in there. "Where's the cayenne?" I'm Indian, I have to throw in some chili peppers in there. It's in there. So item by item, he says, "Where is this? Where?" And with each one, the answer is, "It's in there. It's in there. It's in there." That should be the same response you have in valuation. When somebody says, "Where's the management? Where's the brand name?" It's in there. It's in there. In a good valuation, it should already be in there. You're saying, "Where is it?" You know where it is in my valuation? Take a look at that margin, 15.57%. The median operating margin for an S&P 500 company is about 6 to 7%. Why are Coca-Cola's margins so high? Well, remember, Coca-Cola is a pure brand. I mean, that's all it is. Unlike other companies like Pepsi, which even have bottling, Coca-Cola spun off its bottler. So right now, all it sells is the syrup, and the syrup costs absolutely nothing to make. So all their costs are actually just selling and advertising costs. They have huge margins. They have incredible pricing power. Those high margins translate into high returns on capital. Those high returns on capital give me high growth rates. Those high growth rates and high margins translate into higher value. That's what I told him. He said, "I don't believe you." I said, "Okay, let me show you how I came prepared because I knew this question was coming." And I got lucky because I found a company called COTT, C-O-T-T. It's a Canadian company that makes just generic stuff. You're saying, "I've never seen it." Next time you go to a grocery store, pick up one of those Pathmark sodas or Grand Union sodas or whatever take a look at who made it. You'd be surprised at how many of those generic sodas are made by COTT. It actually sells almost as many cans of soda as Coca-Cola does, but it sells them directly to the grocery store to put their own name on it. It's a pure generic company. So here's the question asked. If tomorrow we all woke up with selective amnesia, this is every marketing person's nightmare, let's make it come true, and we'd forgotten the word Coca-Cola and the red can that went with it, what would happen to Coca-Cola? Well, it'll become like COTT. It'll lose its pricing power. It loses its pricing power, its margins are going to go from 15.57 to 5. So I'm going to let Coca-Cola sell what it sells now in terms of revenues, but I'm going to lower the margin. Those lower margins will translate into lower returns on capital. Those lower returns on capital will translate into lower value. And if I trace it all the way down, I come up with the value for Coca-Cola with generic margins of $15.4 billion. You want me to give you a brand name premium? I just did, right? How much is the brand name premium I'm assigning? Take the difference between those. I'm giving you a $64.2 billion brand name premium. So I agree with you. Your biggest asset is your brand name. Don't mess with it. But don't ask me to add a 20% premium onto a DCF valuation, because if I've done this right, the brand name value should already be in there. You're saying, what if the brand name is not being utilized right? That's a different question. I could ask that about any asset. Maybe you have a valuable brand name like Quaker Oats did, and you're wasting it. We can talk about how to use it more efficiently, but that's not a brand name premium. That's a control premium you'd apply to any type of asset that's underutilized. So when you think about brand name, try that out. And as I said, it works best for things like cereal, soda, drugs. You know where it doesn't work that well? If I asked you what the brand name, in fact, Interbrand, which is this UK-based company that ranks companies based on brand name, you know who they ranked highest in terms of brand name value this year? It's been the same company for the last 3. It's Apple. And I've always wondered how you value Apple's brand name. It's much more difficult than value Coca-Cola's brand name, right? Because Apple's brand name, the pricing premium that you see on an Apple is not just because of brand name, it's also because of operating system, it's other stuff. And the more other stuff you have in the game, the more difficult it becomes to isolate the value of just the brand name. So let's review. We've got all these multiples. They can be equity multiple or enterprise value multiples. Every single multiple, what you need to do is go back to a discounted cash flow model, work through the algebra, and once you work through the algebra, you're going to see the variables pop out at you. And that companion variable, the variable that you most twin with that multiple, should be the variable you should focus on first, but then you can ask the questions about the rest as well. So we've defined, we've described, we've analyzed. Let's talk about applying a multiple. If you've done the homework of getting to this step, application becomes relatively simple, because there are two big questions you face when you decide to do pricing. The first is, remember, you've got to come up with those comparable firms. So you have to tell me what a comparable firm is. And if you look at equity research reports, it seems to be pretty simple, right? If you're a software company compared to other software companies, you're a utility, you compare to other utilities. Someone asks you a question, why? Why do we stay so sector focused? Because in valuation, when I talk about comparable firms, a comparable firm is one with similar growth, similar risk, and similar returns on equity, right? It's all about the numbers. What does it matter to me whether my comparable firm is a utility or a software company? It's a lazy way of doing comparable, but that's what we've done for as long as we've been doing pricing. So I want to throw that on the table. Maybe the way we're defining comparable reflects the world we used to be in, where we had no choice but to take the 20 technology companies, and not the world we're in now. And second, no matter how careful you are about coming up with those comparable firms, there will be differences between the companies that you have to control for. So let's start with the first of those questions. When I want to value a company, or let me take that word out, price a company, how do I come up with the right comparables to use? And broadly speaking, you have two choices, and you're each going to run into this. Maybe not in the mystery project, but when you price your company. That's the second part of your big project. Is you can price your company by trying to come up with a group of companies that look just like yours. So basically you might say, I want a company that's in my sector, has a similar market cap, similar growth. So you can start doing screens and say, these three companies look just like mine. And at the other extreme, you can go with a much bigger sample of companies with big differences across the companies and try to control for those differences. So those are really the two choices you face when you do pricing. Do I want to go with a really small sample of companies just like mine, or a really big sample of companies and control for differences? And I'm going to give away my biases. It goes back to the law of large numbers. And it's something that I've kind of been faithful to all the way through this class. When I asked you to estimate a beta for your company, I said, I'd much rather have a big sample of companies and let the law of large numbers work in my favor than go with a smaller group. But it really depends on what you plan to do after you get that comparable list. Because here are the four ways you can compare across companies. The first is you can make direct comparisons. GM looks expensive relative to Ford. So basically you take two companies that you tell me are just like each other, and you make the comparisons between those two. Amazon versus Netflix, Facebook versus Google. Be careful when you do that though, because you have a sample of one and you're making that comparison between the two companies. The second is you can compare your company to 3 or 4 or 5 other companies and tell me stories. You see what I mean by stories? Your company trades at a much higher multiple than these three, but it's okay because it has higher growth, a lower risk. The story actually sounds intuitively reasonable, but you just leave the story. You don't make any attempt to actually quantify the story. The third is you try to bring in the variable that you're most concerned about, is different across these companies, into your multiple. That sounds mysterious, but that's exactly what PEG ratios try to do, right? You can almost see the guy inventing PEG ratios doing a dance. Right? He had 15 tech companies, different growth rates. He's comparing PE ratios, and he keeps coming up with these low PE ratio companies that have low growth rates. He says, I have to do something about it. He divides the PE by the growth. He says, I've got a growth control multiple. Or the fourth is you can draw on statistics. Control for differences across companies. So here's what I'm going to do. I'm going to play the role of an equity research analyst, a really bad equity research analyst. And that's not a tough role to play. And I want you to rip me apart with every recommendation I make. So ready? I'm going to be the beverage analyst. This is my sector. So very different companies. I'm going to come to you with 2 stocks on this sector that I really, really like. One is No, actually 3 stocks. Hansen, Todd Hunter, and Andre Wine. I'm a very naive analyst. You see why I picked those 3, right? Those are the 3 companies that trade at less than 10 times earnings. Hansen, of course, makes the Hansen sodas that you've probably seen. Todd Hunter, I have no idea what they do. Andre makes the wine that's so cheap. You usually see their commercials before Christmas. The champagne that's so cheap that watching the commercial gives you a headache. Right? So this is your desperation time. You have $7, you want a big bottle of champagne, you buy an Andre bottle. So they all look cheap, right? Because they trade at low PE ratios. So go ahead. Tell me what I'm missing with those 3 companies. I've made it actually pretty obvious here so you can do it without having to dig too deep. Why do Andre Wine and Todd Hunter look really cheap? What do they have? They have low growth. Now, Hansen looks pretty interesting. It has high growth. It has high risk. I made it obvious because I wanted to make this an obvious example, but all I'm saying is when you sometimes see a stock that looks cheap, the answer is right there looking at you, but you got to bring it into the process. Andre Wine and Todd Hunter are cheap, but they also have low growth rates. Hansen Natural looks cheap, but it has high risk. Now you can see the problem with storytelling, right? Because you still don't have a decision. All I've told you is a way of explaining away why some stocks trade at low PE and high growth. So let's take the next step. Let's say we want to go beyond storytelling. So I was fired as the beverage analyst. I've managed to go back in time and become the telecom analyst. In my sector are foreign telecoms listed in the US and have ADRs traded in the US. So this is from the late 90s when a lot of foreign telecom companies that used to be government owned got privatized. And they had the advantage with ADRs is, at least in theory, all the earnings should be computed using GAAP rules, so the earnings should be comparable. So here again, I'm going to play the role of a naive analyst. I still have only one tool, PE ratios. The only way I know of picking stocks is I pick a stock with a low PE. I pick Telebras. I could have picked Indosat, but I don't even know where Indosat is, so I said Telebras. I know where that is, Brazil. I like Telebras because it's trading at 8.9 times earnings. I've given you one reason why it's trading at a low multiple. It is because its growth rate looks much lower than the rest of the sector. But what else should I be worried about with Telebras here? This is late 90s, Brazilian company. This is when emerging market risk was just raging, right? And if you look at the other telecom companies, I have the Danish telecom. In fact, I have a subset of emerging market ADRs and developed market ADRs at a time when emerging markets were very different from developed markets. So 2 things worry me, right? One is that Telebras has low growth. The other is it's an emerging market ADR. So here's what I decided to do rather than stop with that story. I opened up my statistics books, that chapter on multiple regressions. Somebody described to me what I do in a multiple regression. I have a dependent variable that I try to explain with independent variables, right? What's my dependent variable going to be? What am I trying to explain? I'm trying to explain PE ratios. What are the 2 things I'm worried about? Growth and risk. I ran a regression of PE ratios against growth and risk. The growth was easy. I had a growth rate. The risk was messier. I had no measure of risk. So I created what's called a dummy variable. The dummy variable, what you do is you attach a value of either 1 or 0 to the variable. So with this group, what I did was, if you're an emerging market telecom company, I put 1. And if you're a developed market telecom company, I put a 0. I ran the regression. I got an R squared of about 66%. If you tell me that's not a high enough R squared, statistics classes have ruined you for life. Only in statistics classes do you have R squares of 90 to 95%. Whenever you run a regression, you see a 95% R squared, it's because you're testing something not worth testing. Things like, what's the relationship between how much you eat and how much you weigh? You eat 50,000 calories a day, you're going to weigh a lot. But for some reason, we think if the R squared is not 90%, the regression doesn't work. 66% is about as good as it gets, so I'm okay with that. But let's break down the regression. There's a constant. Anytime you run a regression, you're given a choice of constant and no constant. Most of the time, it's good to leave the constant in there because otherwise you're messing with the regression. 13.12. What does that tell me? It tells me nothing more than the base from which I'm going to build off. I have a coefficient of 121.22 on the growth rate. Somebody explained to me intuitively what that tells me about growth and PE. As growth goes up, obviously PE goes up. Every 1% increase in my growth rate increases my PE by about 1.21. So if your growth rate is 5% higher than mine, your PE ratio should be roughly 6 higher than mine, 5 times 1.21. I've quantified. So now I'm no longer telling you a story about growth, I'm telling you how much growth matters. And then I got to the emerging market dummy, and this is, I think, the most interesting coefficient. Minus 13.85. Somebody tell me in intuitive terms how I would explain the minus 13.85 to somebody who's not a statistics person. What is that telling me? It is what? So I have two stocks, two telecom companies, one in a developed market, the other in an emerging market with exactly the same growth rate. What's this regression saying? It's saying the emerging market company should trade at a PE ratio of 13.85 lower than the developed market company. You're saying, what if the market is wrong? Remember, you entered the pricing domain. The minute you enter the pricing domain, what do you say? I'm listening to the market. If you think the market's wrong, just do a DCF. I want it to be there. You drag me into pricing. And if you drag me into pricing, I'm going to say, look, let's go the distance. Let's listen to the market. This is what the market's saying. An emerging market dummy variable cost me. Now, why did I start on this? Because I thought Telebrass looked cheap, right? So here's what I did as my final step. I plugged in Telebrass's growth rate into the regression and the dummy variable of 1 because Telebrass is an emerging market company. I got a predicted PE for Telebrass of 8.35. So at 8.9 times earnings, it looked cheap, right? But after I controlled for its low growth and the fact that it's an emerging market stock, it actually is slightly expensive, not cheap. The best way for you to kind of get that same sense is pick a sector that you feel comfortable. Maybe a sector you worked in. Pick 20 companies, take a multiple. Pick any multiple you want. See what drives that multiple statistically. I'm not suggesting that regressions replace your analysis, but they're a useful tool to bring into the process, especially when you start talking about 25, 30, or 35 companies in your sample. Any questions on it? So by now you kind of get where we're going with this, right? So let's switch sectors. I got fired as the telecom analyst. I land on my feet. I'm now the European banking analyst. This page I actually have listed in 2010 what the price to book ratios for European banks are. And you can see they vary anywhere from 0.8 for some German bank, usually a really long name, to 3.33 for Lloyd's. I've also, for your help, thrown in return on equity for the banks and the risk of the bank into the picture. Just take a look at those three columns, and already you can see a pattern emerging, right? You look at the stocks with the lowest price to book ratios, they tend to be the stocks with the lowest returns on equity. High price to book ratio banks tend to have higher returns on equity. So if your job is to pick a cheap bank, tell me the combination you want. Do you want a low price to book or a high price to book? Well, you want a low price to book, right? So you want a stock that trades at a low price to book. Let's put a benchmark for that. The median price to book for the sector is 2.07. So you want a bank that trades at less than the median. Let's keep going. Do you want a bank with a high return equity or a low return equity? You want a high return equity? Again, let's use a benchmark. You'd like a bank with a return equity greater than 11.82% because that's a median. And you want a risky bank or a safe bank? You want a safe bank, so you want a low standard deviation, which means if you are just using the median, here's what you'd like to find. You'd like to find a bank that has a price-to-book ratio less than 2.07, has a return on equity higher than 11.82%, and has a standard deviation less than 21.93%. I looked through the sample. I have some bad news. I couldn't find a single one. But no harm looking. If you reverse that, an overvalued bank here would be one that trades at a high price-to-book ratio, price-to-book greater than 2.07, has a return equity less than 11.82%, and has a standard deviation higher. It's a very simplistic way of doing pricing, but it's actually a way in which you can bring some statistics in, but you don't want to use regressions. Use the medians as your judgment call. See which stocks trade at less than the median, and have, on the other parameters, the numbers moving in the right direction. So I got a little frustrated because I couldn't find any really undervalued stocks, banks, and really overvalued banks. So I put up my statistics toolkit again. I took the price to book ratio for banks. So this is just the banking sample you said. Ran a regression against return equity and standard deviation. When you run a regression, first thing you want to do is make sure it's statistically significant, right? So that's why I reported the t statistics in brackets. And if you remember the old rule for t statistics, if you get a t greater than 2, you can at least claim to be statistically significant. R squared of 79%. But here's what I get from this. Every 1% improvement in my return equity increases my price to book by 0.0363. Every 1% increase in my standard deviation reduces my price to book by about 0.0268. In fact, after I did this, I looked at the standard deviation and maybe that's not the right proxy for risk with a bank. In fact, right now, when you look at banks in trouble, what are we talking about when we talk about banks in trouble? We're talking about regulatory capital ratios being too low, right? In fact, I toyed with the idea of making a mystery project about just banks. I was going to give you every publicly traded bank in the world. I was going to give you the numbers for price and book and return. In fact, if any of your groups want to do that as your alternative project, I'm perfectly okay with it. And if you want to if you can pull the data up, fine. If you want me to pull the data, I'll pull it for you. Because I think it's an incredibly fascinating exercise right now to ask, why do some banks trade at well below book and others trade at well above book? Because I think there's something structurally changing in banks that we're missing by just looking at the history of these banks. So once I had that regression, I could use it to get predicted price to books for every one of my banks. So all I did was plugged in the return equity and standard deviation for each bank. I get a predicted price to book. I compare the actual price to the predicted price. So this is like a one-man process where you can take 20, 30, 50 companies and come up with percentage undervaluation and percentage overvaluation, again based on a purely statistical forecast of what those variables should be. Any questions? Yes?
Sorry, I'm not really good at statistics, but question about using dummy variables. If you do choose 0 and 1 and you chose like 0.1 and 0.2.
You can't do that though, because in a sense, then reading the coefficient becomes more difficult. I mean,
Using 1 and 0, isn't it somehow putting a weight on the value that you're expecting?
it's a very raw way of measuring risk. In fact, today, here's another alternative. If I were doing this today, rather than the late 90s, I would use a country risk score. Or I would take the rating for the country. You see, if you can make it continuous, because right now what I'm doing is I'm treating all emerging markets and putting them in one basket. And that might include Chile and that might include Brazil. And you're saying they're not equally risky. So by allowing, so your choice is, do I want to go with a 0, 1 or with a continuous variable? And if you can find a continuous variable to capture something, I'd much rather have it be continuous rather than have it as a dummy variable. So my suggestion is, if you don't like dummy variables, and I can see why that might be troubling because I'm putting all these companies in one basket, is to replace it with a continuous variable. So rather than make banks risky banks and safe banks, I look at the tier 1 capital ratio. That's going to give me a continuous measure of risk, and that's the advantage you get whenever you have a continuous measure of risk. Yes? You can do it. See, that's the nice thing about pricing. There are no rules. As long as you do it the same way for every one of your companies, I'm going to say, okay. Because what am I assuming? I'm assuming that if you use historical variances, that they're all, as long as you don't have any bias that comes from the data, you get to pick how you measure risk. You get to pick whether you use implied numbers or historic numbers. Because in a discounted cash flow valuation, I can count as that's not right. That's not what you should be doing. In pricing, there is no such thing as that's not right. If the market thinks it's right, it's right. So it actually is, you get the freedom to define things the way you want to define them. And that's why in your mystery project, I've given you historical growth and expected growth. I'm not saying one is, so you might decide, so sitting there, it should be expected growth, but what you and I think should matter is irrelevant if you're doing pricing. It's what the market thinks that matters that you should be putting into the pricing. Yes? It's a good question. Am I removing outliers? I generally don't. And here's why. Once I get started, I can't stop. You see where I'm going? You take that, you take an, and if you're going to remove outliers, you've got to remove them in both sides, right? You can't just remove the high numbers. So basically, you'll have to remove the highest and the lowest, And then you're going to get a new highest and a new lowest. And before you know it, if you keep doing this, you're going to end up with a sample of 5 companies that are all around the same number. But why are they an outlier? Maybe I get more information by looking at the outliers than I do by looking at the inliers, if there's such a word. Basically, the outliers are giving us information about what markets might price. Maybe there's something that Amazon is doing that markets really price in at a high value. And if any other company is doing exactly the same thing, maybe I should be attaching a high price to it as well. So sometimes the outliers can give us information about what markets are focused on. Sometimes the outliers you have to throw out. It might be an accounting problem causing your price to book ratio to be 600. And you're saying, I'm going to throw that out because it's just messing up my regression. But you have to be very careful about pruning your sample because that's the way bias enters into the process. So I want to close with a chart that looks at US banks. And in fact, I should have updated through 2016. But I'll give you the story with banks that makes them so interesting right now. If you look at pre-2008, banks used to trade at 2.5, 3 times book value. Okay? And they used to have really high returns on equity. So high price to book, high return equity, that kind of makes sense. And you get to 2008, of course, banks have this horrific crisis. Earnings drop, return on equity in 2009 drops to 0 pretty much. The price to book comes down. You're saying, that makes sense. I have low price to book, low return equity. And for a couple of years after the crisis, that was our explanation for why price to book ratios had come down. But if you look at what's happened since 2009, in fact, this chart keeps going, the return on equity has climbed back, maybe not to 2007 levels, but close to 2007 levels, but price to book ratios have stayed low. Now, there are 2 ways you can read this. One is you can say, markets are really underpricing banks. I'm going to load up my entire portfolio with banks. Put it all in a bank ETF. And you could do that, right? And you're assuming that things are going to revert back to a historic relationship. But what's the other more questioning way of looking at this number? What else might explain why, even though the return equity has climbed, the price to book has stayed low? One is that the risk has gone up, that the perceived risk for a bank, and I'll use beta just as a kind of shortcut. Pre-2008, the beta that I got on average for banks was about 0.94. Banks were typically less risky than the average stock in the market. For the last 6 years, if you look at the betas that I have for banks, the levered betas, they've consistently been above 1. So part of it is that markets, for whatever reason, believe that banks are more risky than they used to be. What else? When I say return equity, what am I doing? I'm taking the net income the banks reported last year and dividing by book equity, right? So what might markets be looking at when they look at that net income? They're asking, what are you holding back from us? Because after the last 10 years, do you trust banks to tell you the truth? You're saying, maybe you have this big loss and you haven't told me yet. You're saying, that's so unfair. Hey, it's nothing about fair or unfair. Markets basically have perceptions based on history. So I think both things are driving banks down. And that's why I think looking at banks more carefully might find you some banks that are truly mispriced. Because people are confused right now about how to value banks or how to price banks, and you're going to see that show up in the numbers. So if any of the groups want to switch from doing your 313 companies, looking at just banks, even you can look at just US banks, they're like 350, and find the cheapest and the most expensive banks, and I'm okay with that. And I'll even supply you with the data if you need it. But you can do this with any sector, not just banking. Now, every year I also pull up the 100 largest market cap stocks in the US. And I do a scatter plot. It's the power of visual analysis. So this is actually from January 2010. I pulled up the price to book ratios for the 100 largest market cap companies and the returns on equity. And you know what a scatter plot is, right? You take each company and you plot it in. So there should be 100 dots in here. Then I draw 3 lines. You know what the middle line is? That's actually the best fit line, the regression line. The 2 outer lines are actually the 90th percentile. So when you run a regression, so if you use SPSS or Minitab, it'll actually do this for you, run the regression line. Any point that falls within those 2 outer lines, you can't statistically reject the hypothesis that they're fairly priced. So what you're looking for are stocks that fall above the line and stocks that fall below the line. So here's my first question. If I'm looking for overvalued stocks in this graph, are they going to be the ones that fall above the line or below the line? They're going to be the ones that fall above the line. And I'll tell you which three came out. It was Google, Infosys, and Gilead Systems. I want you to think about those three companies for a moment, because whenever you see companies look overvalued or undervalued, the question you've got to ask is, what might I be missing? What do you think those three companies share in common? They were growth companies. And what I'm doing is price to book and return equity. I'm not controlling for growth. So one of the things that's popping up is higher growth companies are going to look cheap because I'm not controlling for growth. We'll talk about what to do about that. Then I'm going to go below the line. And the three companies that came out as cheap were ConocoPhillips, Nokia, and ExxonMobil. Whenever you see companies look cheap, and this is a suggestion even in the mystery project, and you find a significant proportion of them come from the same sector, that's a red flag that you should be thinking about, that maybe there's something happening in this sector that you're not controlling for. And in 2010, you know what that was? Oil prices had dropped in 2010, and the earnings that I was looking at from the most recent year reflected much higher oil prices. So when I divided the price today by the book value, markets already could see what the oil prices were, but the return on equity reflected last year's earnings. You think that was such a waste of time? The 100 largest market cap companies, I'm not surprised. And with the scatter plot, you can already see that when you pick two variables, you're implicitly assuming that the others don't matter. So we obviously are missing growth and missing risk. Can I bring them into a scatter plot? Why not? It's a three-dimensional graph. It makes your head spin. Think of it as a cardboard box in front of you. I'm looking for cheap stocks. So tell me which corner of this box is my cheap corner. So let's start. You want low price to book or high price to book? You want low price to book, low return equity or high return equity? You want high return equity, so basically we're low risk or, low growth or high growth? So basically you want stocks in this corner right here, right? Low price to book, high return equity, and high growth. There's nothing there. The closest you get is Time Warner, see? Again, should be no surprise, 100 largest market cap stocks, heavily followed. You shouldn't expect to see a massive surprise. In fact, if I made the three-dimensional graph, price to book, return equity, and risk, my cheap stocks are in this corner. Low price to book, high return equity, low risk. Again, nothing there. The closest I get is ExxonMobil after I control for all three. But my suggestion is, rather than pick the 100 largest market cap stocks, if you took 100 mid-cap or 100 small-cap stocks, where people are not looking at these stocks carefully, who knows? You might actually find a diamond in the rough, a stock that is actually massively mispriced because somebody is missing something. So actually, it doesn't take very long. If you have access, again, all you need is an Excel spreadsheet. And I just use the 3D graphs from Excel. And you can actually graph out the three variables and see what they look like. And it's a great place to start your analysis because it's visual. You can see things that stick out. And then you can ask the follow-up questions. So I'm going to close this 100 market cap stock thing by running a regression again. Why? Because if I want to control for more than two variables, you can already see I can't do a four-dimensional scatter plot. I could try. I'll have four different. I've seen people do it. It's just I don't know how to even read them. So I ran the regression, price to book against risk, growth, and return equity. You know why I picked those three, right? Because when I did remember the algebra? Those are the variables that popped up when I did price to book. Again, every single one of these variables, if you look at the T, just the growth and return equity is significant. I might as well have thrown beta. Does that surprise you that beta doesn't matter? These are the 100 largest market cap companies. My guess is that the betas are not going to be 3 for any of these companies or 0.3. So I'm not surprised that beta doesn't matter in this particular grouping, that it's return on equity and growth that drives differences in price to book ratios. Here's what January 2015 looked like. The most expensive companies, no surprise here, you got Amazon here, you got Celgene, Clorox, and the cheapest companies, IBM, is the only one actually that is below the line enough that I can say it's cheap. Again, don't do anything stupid and go out and put all your money in IBM. But it's a way in which I kind of narrow my focus. Because let's face it, when you sit down to invest in stocks and you want to do valuation, let's say you're a believer in intrinsic valuation, you can't start with A and work your way all the way down to Z. You don't have that much time. You want to focus your attention on the 25 or 50 companies where chances of finding an undervalued company the greatest. I actually use pricing as my front to screen for where I want to do my intrinsic valuation. I don't want to be wasting my time valuing 95 companies, only 93 of them are going to be fairly valued. This is an effective way of kind of cutting down on the number of companies you want to do that detailed analysis. Let's do one final. Now I'm the trucking analyst. Very boring sector. Don't even try to read that page because the numbers are too small. But I'm going to give you my buy recommendation. My buy recommendation is Ryder Systems. Why? It's a company that you probably have heard of. You've seen the Ryder trucks across the country. And the reason I like it, it's trading at 2.8 times EBITDA. That's really cheap, right? So ask me the questions. So I'll put the pitch to you. Ryder Systems looks cheap. It's trading at 2.8 times EBITDA. First question you're going to ask me is, what's the tax rate? So that'll put your mind at rest. Its tax rate is about 30%. All trucking companies are around that tax rate. You're going to ask me, what's the return on capital? Its return on capital is about 9%, pretty much what it is across the sector. Margins, pretty much the same across the sector. You're going to say, how much are they reinvesting? And here I've got to let you in on how trucking companies tend to reinvest. Trucking companies don't do CapEx every year. They replace their entire fleet every 4 or 5 or 6 years. Why? Because they get bigger discounts when they do the entire fleet. So rather than ask me what my CapEx is, what's the question you should ask me? How old is my fleet, right? And Ryder Systems had the oldest fleet in this entire sector at the time. This was from an actual equity research report. The analyst had put a buy recommendation on Ryder within 2.8 times EBITDA as his primary basis. And all I did was I went through the 10K for every trucking company, and it's given there as how old the fleet is. I added that as a column to the Excel spreadsheet. And all I had to do was add that, and when I did that, it turned out that Ryder Systems looked cheap, and if I put my money in it 2 or 4 weeks from now, here's what I'm going to open up the Wall Street Journal to read. Ryder Systems borrows $3 billion to replace it. Overnight, my EV to EBITDA is going to go from 2.8 to 4.5 times EBITDA. There's nothing wrong with pricing. But when you're pricing, you should always stop and ask those what. And that's my problem with pricing. It's not that people use multiples and that they use comparables. That's perfectly okay. But that they want to use multiples and comparables, but they don't want to control. Ask those very simple follow-up questions, which would allow them to decide whether a company is truly cheap or whether it just looks cheap. So when you get a chance, look at the data from the mystery project. You have all the tools you need. And if you need more tools, open up your statistics book. You're not going to find it in my book. You're not going to find it in finance. Your tools are statistical tools at this stage, because you've got to come up with those pricing judgments on the sector. Yes.
A minute.
Yeah.
I have a question regarding this. It's like the last question, section B, and I'm not really sure why you didn't get any credit here.
It's all or nothing, right? Did you use accumulated cost of capital?
Yeah, I think the mistake is that I started with the wrong free cash flow, but I was like punished here already.
Where's the present value?
Here.
And
I
this
was
is
summing it up.
No, but is this the right present value? Did you make?
Yeah, I was recalculating it in Excel. And if I start with that number, I get the very same numbers in here.
It should be about 70% of this number. So why is it so low?
Because this is the discounted cash flow from here.
So it's not this number
No,
discounted?
and then I summed it up and discounted it together.
So it's this number discounted back.
Yeah,
It's
it's
minus
the
380?
290.
Okay, then it's fine.
Then I summed it up, got this, and it's always going You know, the discounted, I put it here, then I summed it up, discounted it
No,
together.
but when you discounted, did you discount at the accumulated cost of capital, or did you take that year's cost of
Yeah,
capital?
I did.
You did use accumulated.
Yeah.
Okay. So just send me an email and I'll fix it.
Okay.
So that's
Do you need it? Or?
no. Just send me an email. Hello there. So you got a 10 finally.
Yeah. I watched all the lectures.
Good.
My company at Q3, it's the money losing company, and let's say it has a ton of debt. It took 500 million and restructured it, and I think it actually issued common shares. I haven't done the math.
Yeah.
To replace the debt
Did it recently since the last?
at Q3,
Oh, Q3,
and they
okay.
just announced it,
Yeah.
and the markets have reacted quite positively. Let's say I do the math. I haven't done it yet, but I'm pretty sure it's going to kind of be the same value, like 500.
But the probability of default,
probability of
that's
default,
the place
that's-
it's going to
so
show
I
up,
was
right? That's
thinking-
what they've changed.
Exactly. So I was thinking about in coming up with my percentage likelihood of making.
Are they rated?
It's like CCC.
But did they do a re-rating? Because when they did the equity issue, there should have been a re-rating, right? Because I would, because of the ratings agencies, the minute you use equity to pay off debt, if you're a highly levered company, you will at least go. Maybe it's too early to do the re-rating, but my guess is that they moved from triple C to maybe double B. So one way to actually estimate the probability of default is actually take the rating and back it out. Triple C is almost a 50% chance of default. A double B is down to a 31% chance. Yeah. So the 50% would have been right at triple C, but now if they're double B, it's more like 31% to 28%. So if you just change the 50 to 28, that's going to have a significant difference in your value per share. So I would check to see whether the ratings agency have done it. If they haven't done it, I would do a synthetic rating by replacing the interest expense with what it will be with the new debt, and maybe come up with a higher rating. And if you can't find that, just give it a higher rating, double B instead of triple C, and use that as your basis for it. And if you look at the corporate finance class, I actually have the probability of default when you do the